Adam Bergman, IRA Financial. We're going to start this webinar in a minute or so. It's on solo 401k contribution rules in detail. I'm going to really go through the nuts and bolts in applying the solo 401k contribution rules. So it should be, I think, very helpful to our clients. This is only open to clients of IRA Financial that are up to date and have paid our compliance service fee. So thank you. I think this is going to be very valuable to all of you to maximizing contributions to your plan, which is the foundation for what we're all about, is making sure people maximize their retirement benefits and maximize the amount they're putting in to their retirement accounts, and at the same time taking control over their retirement funds so they can invest in what they know and trust, like real estate. Okay, we're going to start solo 401k plan contribution rules in detail. I think this is going to be very helpful to all of you who have solo 401k plans. We'll go through some of the rules, eligibility rules, some of the basics of solo 401k, and then we're going to dive into how contribution rules work in depth and talk about them and really scrub the different type of contribution options, whether they're employee deferral, profit sharing, or after-tax deferrals, and talk about how they work, how one can maximize their benefits, and how the implication of making pre-tax Roth or after-tax contributions would work for you. If anyone has questions, you can send them in, and I'll take the last 15 minutes or so to answer them. If I don't get to all the questions, I will either do a follow-up webinar or I will answer them directly when I have a chance over the next few days. But this is for solo 401k. So if you have an IRA, a self-directed IRA, and you're listening or watching, thank you. You're not going to hear a lot about investments on this presentation. This presentation webinar is about maximizing contributions and understanding how the solo 401k plan contributions work. So if you're looking at or interested in knowing more about investment options for your retirement plan, you'll have to come to another webinar. I think the third one in the 4-part series is about investments. This one is going to be nuts and bolts. If you are self-employed, have a solo 401k, thinking about a solo 401k, heard about a solo 401k, want to learn more, the next 45 minutes I think are going to be very fruitful and entertaining. So what is a solo 401k? Well, it's not a new type of plan, right? It's really a 401k under section 401 in the Internal Revenue Code that actually is targeted and was designed specifically for someone who's self-employed. Most Americans have heard of a 401k. There's about 60% of Americans that have access to retirement accounts, several million 401k plans out there. Most of us have heard about what a 401k is, right? If you work for a company, most companies, large companies will offer 401k plan benefits. 401k plans were essentially became, I think, more common, and definitely when ERISA was passed in 1970, early 70s, really gave more direction and more power and more, I think, protection to employees that are participating in plans. 401ks are definitely the most popular type of defined pension plan. There's two types. There's a defined contribution plan and a defined benefit plan. Defined contribution plans, which is essentially a 401k or a profit sharing, are the most popular. That's where the actual employee gets to make decisions based off their deferrals. They have control. A defined benefit gives someone a defined benefit, as the name states, a certain amount at retirement account. Defined benefits used to be the norm in the 60s and 70s. The argument for defined benefit is that there technically could be a bigger pot of gold at the end for employees, but it's a way bigger cost to employers because they have to fund a certain amount for each employee based off their age and salary, versus defined contribution, the employer has less risk and less responsibility. So 401k is a defined contribution plan, and a solo 401k is a special type of 401k plan. Prior to 2001, EGTRA, Economic Growth, Tax Relief and Reconciliation Act, there wasn't much value in having a solo K. So most people had SEP IRAs, KEO plans, or just a pure profit sharing plan. which is basically a SEP IRA and a KEO plan. They're profit-sharing plans. So a profit-sharing plan means that the employer can put away for each participant, but again, in a solo K, it's generally a one-participant plan, which we'll get to in a minute, a certain percentage of their salary each year. And generally, the maximum is 20% if you're self-employed or a single-member LLC, or 25% if you are a W-2 employee of a corporation or receive a guaranteed payment in a 1065 partnership. And KEOs and profit-sharing plans, just like a SEP, were easy to operate, and they were basically pure profit-sharing plans. In contrast, if you worked at a company like Ford or GE or just ABC pizza restaurant, they may have had a regular 401k defined contribution plan, which had an employee deferral portion, which let the employee put away up to a certain amount dollar for dollar, plus a profit sharing component. So prior to 2001, if you worked at a larger business, you probably were potentially benefiting to a greater extent from a retirement standpoint because you had that employee deferral option, which you really didn't have in a KEO plan, a SEP plan, or a solo 401k prior to 01 because there was no deferral option. So again, prior to 01, you didn't see solos. You saw KEOs or SEPs, simples maybe, but real KEOs and SEPs that are pure profit sharing plans. So if you made $40,000, you're self-employed, you get 20% of 40, $8,000 bucks. That was the same for a SEP or a KEO. There was no catch up if you were over 50. There was no deferrals dollar for dollar, pure profit sharing. 2001, ECTRA comes along. President Bush signs this into law after 9/11. It really is a Jobs Act to help increase participation in the job force, help businesses hire people. One of their provisions was increasing the options for employees in a 401k, hopefully an impetus to keep people at your company. And what was done in ECTRA in the 2001 Jobs Act was it added a deferral section to the solo 401k. So it made the solo 401k look like an ERISA 401k that you would have at a multiple employee business. It also had a loan provision, and it offered Roth options, which we'll get to. So solo 401ks were basically reborn in 2001, and that's when their popularity started increasing. And now in 2019, they're essentially the most popular plan for the self-employed. The SEP IRA just as again is a pure profit sharing plan. The solo K gives you deferrals plus profit sharing. So we'll get into some examples of why the solo 401k is so important and so valuable. And if you have a solo K, how smart you guys are. And if you're thinking about a solo 401k, something to think about. One thing I do want to mention about a solo K is there's something called a defined benefit plan as well, which again is not a defined contribution plan. It's a defined benefit. So it guarantees you a certain benefit at retirement age, whether it's 62 or 65. Defined benefit plans are really, really, really super valuable. If you are making $100,000 plus in steady earnings and you're anywhere from 45 and over, you can put away up to $2.8 million until retirement, and that's increasing with inflation. So it's, in some cases, you'll be able to put away a few $100,000 a year, potentially up to $250,000 a year, and get a deduction for that and also have that into your defined benefit plan. So if you think you're in that category, let me know, email me, call me, and I can get you information about the defined benefit plan, which will help you sock away a lot more money, get you higher tax deductions, and allow you to save a lot more than $56,000 or $62,000 in a solo K. Number one, it really works well if you're 40 to 65. If you have steady income, so you're a lawyer, doctor, a dentist, or consultant, one or any business under 15 employees, and you're interested in socking away a whole lot of money, the defined benefit plan will let you put away at least 100 grand plus in a year and upwards of a few $100,000 up to around $2.8 million in the aggregate, which you can then roll over into an IRA, which would likely be a lot more than a solo plan. So the defined benefit plan is not going to work for everyone. If your income's kind of sporadic, some years you got really good steady income, others you don't, or you have a lot of capital gains one year, not a lot of earned income the next, the defined benefit may not work, but if you feel like you have steady income because you're a professional or in the type of business which generates steady income above 100K each year, and you're looking to maximize retirement benefits, DB plans are awesome, and you should ask for more info. So let's talk about we talked about some of the surging interest. EGTRA became law in 2002. How do you become eligible? So why isn't every one of my clients in a solo plan? I would put every single one of my plans. Well, first of all, I put them in a DB plan if I could, defined benefit plan. But for everyone else, I put in a solo plan. Why? You can put away up to 56 or 62,000 if you're over 50. An IRA in 2019, 6 or 7,000. SEP IRA, 56,000. No catch up. So number one, my solo clients will put away more money. Number two, there's a loan feature, right, that an IRA does not, or a SEP IRA or simple IRA does not. Easy to administer. We have a relationship with Capital One. So you'll be able to open a solo K. We'll actually open it for you, and you'll be able to do traditional investments like stocks, but also alternative assets like real estate. So really great from retirement and investment standpoint. So who's eligible? Well, unfortunately, not everyone's eligible. So in an IRA, as long as you have earned income, whether you work for Apple or Joe's Pizza, or you're a lawyer, doctor, or dentist, or selling something on eBay, as long as you have some earned income, you can set up a solo K. Okay, you can be a sole proprietor, single member LLC, corporation, partnership, C Corp, S Corp, doesn't matter. As long as you have some self-employment income, you can open a solo plan. Now, the other thing is, what is earned income, right? I get this question all the time. I am on Social Security. I'm on disability. I have alimony. I buy and sell stocks. I buy and sell real estate. I buy and sell Bitcoin. I'm retired. Can I open a solo K? And the answer is maybe. The answer is really you need earned income. So if you look at the IRS definition of earned income, it's really any income that's subject to self-employment, security, FICA, Social Security tax. So you need to perform some service and in return receive some type of income. So clearly the obvious stuff is, you work at IRA Financial, right? You earn a W-2. You earn a commission as a 1099. You are a doctor, a dentist, a professional. You can even sell something on eBay. You could be a software consultant, a real estate agent. You can tutor math. You could be Santa. I have a client that's Santa Claus for December. He makes a couple grand. He's self-employed. It does not have to be a full-time job. This is very important. You could have a full-time job as a lawyer. On the side, you can tutor someone in math. You can sell something on eBay. You could be an influencer, and Nike can pay you to wear their shoes on Instagram. You can do anything on the side that generates self-employment income and will allow you to do a solo 401k. We'll talk about how much you can contribute to that solo plan, but you are still eligible. So number one, you have to have earned income. Your business can be in any form: sole proprietor, C Corp, S Corp, partnership, doesn't matter. You just need to have earned income, okay? So again, it could, as long as the activity is legal, right? If you're a drug dealer today, probably not something you can set up a solo K. You need to have a legal business that generates earned income, okay? So earned income, again, is income that is subject to self-employment, FICA, Social Security tax, not capital gains, not interest, not dividends, not royalties, not rental income. If all you do is you sit back and you are retired, you play golf all day, and you just collect Social Security, not eligible. If you're on disability, God forbid, not eligible. If all you do is sit at home and you buy and sell stock, not eligible. If you collect royalties from the book you wrote, not eligible, okay? If you just collect dividends from IBM, not eligible. You need to have some earned income. Now, can you be a hotshot full-time lawyer, doctor, dentist, software engineer, receptionist, and on the side be a real estate agent, software consultant, math tutor, sell something on eBay, sell something on Instagram, Twitter, or whatever, and generate some self-employment income that you file a Schedule C or you get a W-2 from your S Corp? Yes, you do not need to have a full-time job. It could be something where you do 10 hours a year. As long as you have some self-employment income, you are eligible. The other second eligibility requirement is you cannot have any full-time employees over 1,000 hours other than another business owner or a spouse. So if I and my spouse own a business, so we're both lawyers, but on the side we own websites where we sell videos on self-directed IRAs, and we earn income and a salary from the business, that even though we are full-time attorneys, we still can have a solo K for our business. And the fact that we're both owners still are eligible. Even if my wife was a sole owner and she hired me, the fact that I'm a non-owner employee will not turn my solo K into an ERISA 401k because I'm a spouse. Spouses are not treated as employees under ERISA. So if you are a self-employed dentist and you hire your spouse to help you out, even though it's a non-owner employee, because it's a spouse, it doesn't trigger ERISA. Why do we care about triggering ERISA? We care about triggering ERISA because ERISA, under the 1974 rules, requires the employer to follow a set of rules, procedures, and regulations that could be costly and have more onerous and burdensome requirements on the employer. So there could be something where there's testing, whether it's top-heavy plan, ADP, deferrals, ACP, contribution percentages, all these tests. There's a 5,500 that needs to be filed each year. So there's more requirements and more costs that have to go into the administration on a year-to-year basis. Whereas if you're a solo K, you're outside the realms of ERISA and all those burdens do not apply. So that's why everyone's trying to get into a solo plan and outside of ERISA. Can't tell you how many people call me trying, maneuvering in any way, form, or possibility to get out of ERISA. And I sometimes have to say, listen, you can't do it. You got 5 full-time employees, okay? You can't not offer them benefits. You can get in a whole lot of trouble and your plan will be disqualified, and you can get into some serious problems with the IRS and Department of Labor if you mess around with those rules. So then people say, well, okay, very simple. I have a dental practice with 6 employees. I'll just set up a new business and I'll consult to that dental practice, and then I'll set up a solo 401k for that side business, and I'm going to then set up my own solo K and, excuse my French, but screw my employees. And I have to say, well, sir or miss, you're pretty smart. Obviously, you're a dentist, but the IRS, Department of Labor, already thought about that. And there's something called controlled group rules and affiliated service company rules, which basically says if you have a controlling interest greater than 80%, 50% in certain instances, they're going to treat all those businesses as one business. So if you did that scenario and you had your dental practice with 5 employees and you set up your own side business, they're going to group those businesses together. The control group rules will kick in and you're back to square one. You're in an ERISA plan, and now you have to offer benefits to your employees, including a matching profit sharing contribution, whatever you're giving yourself, which we'll talk about in a second. So the IRS, Department of Labor are aware of this. They understand people want to set up solo plans because of the valuable contribution limits and the fact that you can give yourself profit sharing contributions and not your employees. And they have these control group rules and affiliated service rules to protect the employees so that they receive fair benefits. And obviously that's equitable and fair. So let's recap. Self-employment activity, right, doesn't have to be full-time. You can do it in a sole proprietorship, LLC, Corp, S-Corp partnership, limited partnership. You just need to have that self-employment activity. It doesn't have to be full-time. It could be part-time. And you can have no full-time employees other than yourself, a spouse, or another owner. So if me and my friend Joe set up a pizza restaurant and it's just us, even though there are more than one owner, because we have no employees other than the owner, we can set up a solo K. So the last thing I want to talk about eligibility is that for employees, when I talk about employees, I talk about W-2 employees. 1099s are not employees. So if me and Joe have a pizza restaurant and we 1099 someone to do our website, that's not an employee. Okay, the IRS has obviously been focused on an employee versus an independent contractor 1099 because 1099s are not subject to Social Security and FICA withholding. They have to do that themselves. So if anything, essentially you can look this up yourself, but overall, if you have control over that employee or person, excuse me, they're treated as an employee. So if you decide when they come, when they go, if they have a desk in your office, computer, and you have control over them, they're probably going to be considered an employee. If they're an independent contractor in the sense that they're independent and they have different gigs for different companies and you have no control over them, then they can quit at any time. They have different hours. They don't come and go. They're not locked into your set schedule. They may be considered an independent contractor, and thus they're not going to upset your eligibility requirement. So that's something you'd have to talk to your accountant or tax professional to determine if you have someone and you think they're an independent contractor, make sure they are. Last thing is that 1,000 hours. Okay, that's the determination whether someone is full-time or part-time. 1,000 hours over the whole year, not over in a month or 6 months, in a whole year. So if someone works 900 hours, they're not full-time. You don't have to give them planned benefits. Okay, over 1,000 hours, yes, it's in the whole year. I'll talk about this later. The Secure Act, which was recently passed by the Senate, is a new retirement bill that likely some form of it will get signed into law by the president in 19. One of the provisions was to move the 1,000-hour threshold to 500 hours. So it'll be easier for, or harder if you want to look at it from the employer side, easier from the employee side to get into the plan. These are the people that are not considered employees, under 21, less than 1,000 hours, union, and non-resident aliens. Okay, so if you're up against that 1,000 hours, make sure you have documentation. Okay, so let's talk about contributions, right? This is why you guys are all listening and watching. You want to maximize your plan benefits. There's basically two types of contributions. There's employee deferrals and employer contributions. Employee deferrals are identified in Internal Revenue Code section 402, and employer contributions are in 404. Okay, and the aggregate limit is in 415. So let's break them down. I like to break these down into basically three parts: employee, employer, and then the aggregate. I think that's easier to understand. Employee deferrals are per participant. So if you work full-time at Apple and you maxed out your 19,000 or 25,000 if you're over 50 in 2019, even if you have a solo plan, you cannot do any more employee deferrals. You're done, because that's a per employee, per person maximum. So even if somehow you're in 5 different solo plans where you got 5 different businesses, once you hit 19,000 the aggregate, you're done. You can't do any more dollar for dollar deferrals. Okay, that's important to know. It's a 402. It's an individual limit per person. 2019, it's $19,000 and it's $25,000 if you're over 50. Okay, and that's dollar for dollar. So if you earn $20,000, you can put away, let's say, around 19,000. Why am I saying around 19,000? Because the number is after Social Security FICA, right? So if you're saying about 6-7%, you made 20,000 bucks, 1,400 bucks or so Social Security and FICA, you could put away, let's say, 18,600, something like that, right? So the number is after Social Security and FICA, and that is a dollar for dollar number. So if you made 6,000 bucks, you can put away probably, let's say, around 5,000. Okay, which is really good because it's not a profit sharing. It's not a percentage of what you make. It's dollar for dollar, which is impressive, and it's just why in 2001 with Extra, solo plans have become the most popular plan for the self-employed, because now you can really maximize your retirement benefits. It's not a pure profit sharing plan like a SEP or a KEO or just a profit sharing plan. So it's dollar for dollar. Okay, it could be in pre-tax or Roth, which is nice. So let's just recap what a pre-tax and a Roth contribution is. Pre-tax, you get a tax deduction, which a lot of people obviously are in favor of. And once you're over 59.5, if you pull that money out, it's subject to tax. Once you hit 70.5, you have to take required minimum distributions on that amount. It's about 3%. Roth is the opposite. You don't get that tax deduction going in, but once you're over 59.5 and the Roth account's been open 5 years, you can pull that money out without tax. Okay, all the contributions and all the income and earnings on that amount. I'm a big Roth guy. I have this battle with my accountant and some of my attorney colleagues, my tax attorney friends. They're big deduction guys. It's not a right or wrong. I think if you're younger, you should be looking at Roth. Personally, I'm in my 40s. I'm a big Roth guy. I wrote a book on the Roth IRA. All my accounts are in Roth, and that's just who I am. I think in a defined benefit plan, which again is a pre-tax plan, I understand the benefits of deductions. If you can get $150,000 deduction, $200,000 deduction, okay, I got you. For me, $19,000 deduction has some value, but I'd rather in Roth because my earnings on that $19,000, I think I can do a lot better than a current, let's say 30% income deduction on the $19,000. Again, if I was in a DB plan and I can put away $200,000 this year in 2019, deduction has a lot more value. Let's say 30% at $60,000 deduction. That's huge. I'll live with that. But for a solo plan, if you're putting in $19,000 30%, you're looking at $5,000 or so. I'll live without that deduction, but I want the tax-free growth. So again, that's something you got to kind of figure out on your own. No right or wrong, but it's an option. Employer profit sharing contributions 404. It has to be in pre-tax. It's an employer deduction. The employer decides. And I get this question, well, I am the employer. What do you mean? I'm self-employed. You're right. In the solo K, it's a little bit strange, the dichotomy between employee and employer, because there's not really a difference, right? If you're a self-employed dentist, self-employed software developer, self-employed real estate agent, you're the employer and the employee. So it's very strange to talk about employer contributions and employee deferrals because it's really all the same. Yes, if you are a solo 401k and you have an S Corp or C Corp, yeah, again, you're pretty much the employer because you're the sole owner and also the employee. From the employee deferral, I just want to be clear, the employee deferral is dollar for dollar on your earned income. So if you're self-employed, it's your Schedule C. Single member LLC, it's your Schedule C. Partnership, it's a guaranteed payment usually, or W-2. C or S Corp, it's your W-2. I get this question a lot. I wanted to make sure everyone's clear. If your S Corp makes $1 million a year, but you only take a $40,000 W-2, the amount you contribute is only off the $40,000, not the $1 million. Okay, it's all off your W-2. So if you made $1 million and you only took a $40,000 salary for whatever reason, and your accountant was okay with that, then you can only do $19,000 or $25,000 if you're over 50, plus 25% of $40,000, not of the $1 million of S Corp profit. Okay. Again, the profit sharing is also based off the earned income, which is either Schedule C or for a single member LLC or sole proprietor, guaranteed payment or W-2 for K1 1065 partnership, C or S Corp W-2. So it's 25%. That's the max. It could be 0%, it could be 1%, 5%, 8%, 12%. Whatever you do for yourself, you have to do for all the participants. So if it's you and your spouse, and you do 25%, it's 25% across the board, both your incomes. Okay, this is a very confusing part of the calculation, and it's not just confusing for lay people; it's confusing for accountants and tax professionals. And I don't want to get into the reason. If you really want me to dig into the reason, I can go through the instructions on the IRS forms about why it's 20% if you're self-employed or a single member LLC, but your maximum contribution if you're self-employed from a profit sharing standpoint, if you're a sole proprietor or single member LLC is 20%, not 25%. And it's really all about double counting. If you do the math and you take 25%, you're getting a double benefit. So they reduce it to 20% to keep it in line with what people would be getting if they were a W-2 employee or guaranteed payment in a partnership. So just to recap, if you're a single member LLC, sole proprietor, it's 20% max profit sharing, 25% if it's W-2 guaranteed payment. So that's important. So if you're self-employed, you make $40,000, sole proprietor, 20% of 40. If you're in 40% of an S Corp W-2, it's 25% of 40. 10 versus 8. There's a reason for it, and I can explain it in detail, but it's not really that important. The importance is just knowing the difference. 20% versus 25, and that's something that people get confused about. If you're using software to file your return, it should catch it. So if you're a single member LLC or Schedule C, it should require you and not allow you to go past that 20%, but you just be aware of that. So again, it's 20% or 25%. Let's run some scenarios, right? Employee deferrals, it's $19,000 or $25,000 if you're over 50. It's dollar for dollar. So if you made $2,000, you can only go up to 2,000, right? So let's say you made $2,000 as Santa Claus, and you take away 7% Social Security and FICA. So you put in $1,400. There's obviously no room for profit sharing, right? Because you hit your 415 limit. You can't go, well, actually, you didn't hit your 415 limit. You hit your limit based off your compensation. So you can never go more than 100% of your comp. So if you earn only $2,000, you're going to be stuck at that amount. But as you earn $1 million, let's go on the other side. You earn $1 million. Well, you're probably going to be able to max out, right? So whether you're self-employed or not, let's just run in on both scenarios. Self-employed, 19,000 or 25,000 if you're over 50, 20% of $1 million. Well, 20% of $1 million is $200,000. That's way over your 415 limit. So based off the $1 million, you're capped at 56 or 62 grand, clearly, right? You can never go above the 415 limit. So if you earn $1 million or $100 million in salary, you're going to just know you're capped at 56 or 62. What happens if you made 100 grand? Okay, so let's run the numbers. 100 grand, sole proprietor, under 50, 19,000 plus 20% of 100, or approximately 39,000. If you're over 50, 25,000 plus 20% of 100, 45,000. Let's say you're a W-2, S Corp, under 50, 19 plus 25 of 100, 44,000. Over 50, W-2 C Corp, 25,000 plus 25,000 as an employee deferral, 50,000. Since that's under the 415 limit, you can do it. Okay, so your limits are either 100% of your comp or the 415 limit of 56 or 62. You can never contribute more than you've earned. And in the 415, aggregate's going to stop you. 404 is profit sharing, right? So you can either do 20 to 25%. Remember, if you do it for yourself, you have to do it for your spouse or the other business owner. And also, the employee deferral is dollar for dollar. So employee deferral, example, me and my spouse, okay, we're each lawyers. I want to put in money, my wife doesn't. That's perfectly allowed, right? It's deferral, an elective. I put in 19 or I put in 5, 12, whatever I put in, my wife puts in 0, that's her prerogative. She doesn't have to put in. It's totally elective deferral. 402 is an elective deferral. Profit sharing, if I say, let's put 20% each, it's for both of us based off our comp, okay? If she has 0 comp, then obviously 20% is 0, 0. But if she earned 40,000 and I earned 40,000, it's 20% each or 25% each, whatever that amount is. I can't exclude her. Even if she puts in nothing on the employee deferral, profit sharing deferral is not elective and it's across the board. You can't discriminate. So something to keep in mind. Employee deferrals, elective, profit sharing, not elective. Employer decides and it's for all eligible participants. Now, if you have someone that's an independent contractor or they work under 1,000 hours, clearly they're not eligible, so they don't get the profit sharing. They're not going to get the employee deferrals either if they're not eligible. But you got to look at your plan to look at eligibility on the profit sharing side. So most of the solo plan people are self-employed. You're talking about one-party plans. The other percentage have spouses, and then the smallest percentage have multiple owners. In some cases, you have some owners. The example, me and Jim, we have a pizza restaurant. I'm just the money guy. Jim's the master chef. He's the pizza maker. He earns a salary. I don't. If we set up a plan, Jim can contribute. I'm not going to be able to contribute. He can deferral my salary 0. My profit sharing amount is 0. My deferral amount 0. Jim could then decide to do 19 or 25 plus a profit sharing based off his salary. So again, employee deferral is dollar for dollar, pre-tax or Roth. It's in the aggregate based off individual. Once you hit your 19 or 25, you're done. Profit sharing is per plan. So let's run some scenarios, okay? Adam's a lawyer at ABC Law Firm. I make $1 million a year because I'm the best tax lawyer in the world. And I put in $19,000 in the ABC Law Firm plan. But on the side, I tutor people on self-directed IRAs and I make 20 grand. So I already hit my 19,000 deferral. So I know on my $20,000 from my side business, I can't do any deferrals, but I can do profit sharing. I'm self-employed. I can do 20% of 20. Okay. And we'll talk about after-tax contributions in a bit, talk about how I can potentially maximize that. So based off that scenario, just real basic, I already maxed out to 19 on ABC Law Firm. So I can't do employee deferrals any longer. on my solo plan, I can do a profit sharing, 20 or 25% of what I earn. And since that's under the 415 limit, I'm okay. The profit sharing is per plan. Okay, so if you ABC law firm, I don't know more than 80% of ABC law firm. If I did, the control group rules could limit me from making profit sharing amounts if I also receive profit sharing on the other business. Okay, so let's take another example. Me and my spouse own a law firm, 50-50 owners. We each earn $1 million. We each put in 19,000. If we elected to do profit sharing on that side, okay, and let's say we hit our 56,000 limit, we're on that side, we're done, right, from the 56 from that plan. Okay, but now if I have a solo business, I can go above that only on the profit sharing. The profit sharing can get me above the 56 or 62 on the profit sharing. I can't do the deferrals because I already maxed out, but since my side business isn't part of a control group, I technically can go above the 56 or 62 from the other plan. So that's not going to work for everyone because most people don't have options where they can contribute to both plans and go above the 56 or 62. But it is possible on the profit sharing side, not on the deferral side, but on the profit sharing side. So that's just something to consider. If me and my wife have a law firm on the side, okay, and we only put in 15,000 each on the deferral, and we have a side business, then obviously we can each go 4,000 more to hit that 19, and then do profit sharings on either side on either business, assuming there's no control group rules, right? If we own more than 80%, if I own 100% of this law firm, and then on the side I own 100% of this other business, it's all considered one business, right? So it's all grouped together. If I own less than 80% on the law firm, and my other side business has no affiliated services to the law firm, and I make profit sharing contributions, I have that option without having to make contributions for my other employees on the law firm side. So control group is something to be careful of if you own more than 80% of both businesses. There's also attribution through family members. So you just got to be careful. They're kind of confusing. If you have two businesses and there's common ownership, let us know. We can go through some of these rules and see if the control group rules will limit you and how much you can contribute. Remember, deferrals are per individual. Once you hit 19 or 25, you're done. Pre-tax or Roth. Profit sharing is per plan, and that's why I allow you to go over the 56 or 62. But again, if you have control group rules, you can't just set up plans for all your businesses and not offer benefits. It's very rare that someone could have 3 or 4 businesses, non-affiliated, where they don't have control group rules and keep making profit sharing. I've seen it. Generally, law firms don't give you any matching contributions for whatever reason, because generally most of the lawyers are putting in money enough that the plan won't be top heavy. So in that case, if, for example, if I work at a law firm and I put in the 19, I'm generally not getting any profit sharing contributions, so I'm not going to get that benefit. But I have some clients that work in Silicon Valley, and these companies will give them pretty high profit sharing contributions, seeing 10-15%, and then they have some side business stuff where they're able to also maximize their profit sharing and exceed the 56 or 62 because of the profit sharing. So that's pretty interesting, but it doesn't happen very often. Again, profit sharing or pre-tax, you can convert them to Roth if you want. This is just a slide to kind of show you the benefits of the solo. IRAs, Roth, 6 or 7,000. SEP IRAs, 20 or 25%, up to 56. There is no catch-up. So if you're over 50, SEP IRA will cap you at 56. Simple IRA, it's actually not 19. I think it's it is 19, and it's a $3,000 catch-up. Solo is 56 and 62. So the solo clearly wins. The defined benefit plan, I didn't want to put in there, but that's the super jackpot. I'm actually writing an article for Forbes on the defined benefit plan that will be out soon. So if people have more information, I'll send it to you. But again, if you make 100,000 plus and you're 40 to 65, 40 to 70 steady income, and you want to maximize, let me know. I'll get you info on the DV plan. It's really a home run. Employee deferrals, again, 19 or 25. It's dollar for dollar. It's optional. It's an elective. The deadline's 12/31. If you're self-employed, you generally have to elect by 12/31, but you can deposit it by when you file your return. So the Roth option is based off the plan. Not all plans allow for Roth. Again, it's pre-tax or Roth. I talked about this, the benefits of each one, deductions versus tax-free gains. On the Roth side, no right answer. I wish I could tell people what to do. Generally, the older you are, pre-tax makes the most sense. If you really need deductions, obviously pre-tax contributions have value. If you're younger and you have confidence in your investments, then I think Roth will win. I get this question, well, can the government change their position and somehow tax Roth down the road? I guess they could. Someone, one very smart man, a mentor of mine once said that Social Security, that happened with Social Security. Initially, Social Security was not taxable, but it became taxable. So it could happen. Who knows who comes to power in the future and could say, hey, we're changing the Roth regime. Tough luck. Whatever happened in the past is the past. You now have to pay tax on a percentage of your Roth. Who knows? I'm hoping that doesn't happen, but there is, I guess, some risk, right? Things have changed. We know that. Employer contributions, again, it's 100% on the employer. It's an employer deduction. It's 20 or 25%. It's not dollar for dollar. It's a percentage up to 20 or 25%. And again, it's teed off your self-employment number or your W-2 number. The deadline for the contribution, unlike the employee deferral, is not 12/31. It's when the company files its return. The IRS understands the company needs more time to decide what it can and cannot afford, so it gives it more time to make those contributions. Here's an example. Kind of went through this example already. It's all tied up W-2. If it's 100 grand, it's 19 or 25,000, and it's then 20 or 25%. Okay. If they did an IRA, it's just 6,000 or 7,000. It's just a SEP IRA. It's just a percentage. So, for example, if someone made $100,000 and they're over 50, okay, in a solo 401k, and they earned it as a W-2, let's say, solo K will give them 25,000 plus 25% of 100 or 50k pre-tax. The first 25 would be pre-tax or Roth under the deferral. Employer contribution would be pre-tax. That's 50k. They had a SEP IRA, 25. So it's double, right? It's just profit sharing, 25 of 50. Crazy. Isn't that crazy? That if they did a solo K, they would be able to double the amount they put into the plan. It's out of control. People are not aware of this. There's unfortunately still tax professionals that I see putting clients in SEPs and simples for no reason other than they just feel comfortable with it. And they are leaving money on the table. You are giving money to the government instead of putting it into your plan. Why should you care? Number one, you can get a deduction if you want to do pre-tax. Number two, that money is growing without tax. That's called deferral. Deferral is the eighth wonder of the world, okay? It's how rich people get rich, get richer. I can't tell you how many people don't understand deferral. I always say deferral should be taught in high school. It should go along with economics or history. People should be understanding the power of deferral. And I keep giving examples how if you start saving for retirement in high school or college, just put in $1,500 a year starting in your teens or early 20s and just keep doing that. Don't even go to 15 or 19,000. Just stay at $1,500 from 20 to 70. You'll have $600,000-$700,000 tax free if you did a Roth. Okay, for doing really no work and really just no sweat off your back. Just putting in very little bit of money each year can make you super rich when you retire. And imagine if you did that in a defined contribution or defined benefit plan, you're going to have millions and millions of dollars. Okay. I am so happy when I hear people saying, hey, I started with you in 2009. 10 years later, I've almost tripled my retirement account by saving and investing in real estate or whatever they invested in. Thank you. Nothing makes me happier. And it's doable. I mean, the retirement system is a system that can make us all rich. Okay, it's really bipartisan. It doesn't matter if you're a Democrat or Republican. It doesn't matter what color you are. It doesn't matter where you were born. And sometimes it doesn't even matter what you do. And a lot of times it doesn't even matter what you've invested in, because if you save over 20, 30, 40 years, you're going to be rich. You don't need to do a defined benefit plan and get $2.8 million in retirement benefits. You don't even need to put away 56 or 62,000. If you do three things, you start early, you are consistent, and you trust the process, you will be rich. Okay, and it's a guarantee. It's math. It doesn't lie. It really doesn't lie. Even if you've made bad investments, as long as you stay the course and keep diversifying and keep saving and keep investing, it doesn't matter if you bought mutual fund 1 or 2 or 6 or 8 or the S&P 500 or the Russell 2000 or the Dow Jones. If you keep it over 20, 30, 40 years, you will have significant money. It's the way I look at it, it's like a one generational sacrifice for all your future generations, right? I'm going to sacrifice and put away a lot of money, and I hope my kids, when I die, just in my IRA, my wife's IRA, will have $3 to $5 million, okay? And that's besides anything else we've saved. That's generational wealth. And yes, $3 million with the time value of money will not be worth what $3 million is today in 40 years. It's still going to be worth something, okay? And that's just an amazing amount of money. It's going to go to my spouse tax-free, and then to my children, if it's a Roth IRA, that money's tax-free. So long as you're under the estate threshold of $11.5 million, not subject to estate tax. Imagine just getting a $3 or $4 or $5 million gift. Your money just hits your account, no tax. Okay, that's like making $6.5, $7 million. So depending on what it is, 3 million, maybe it's worth 4 million, right? 5 million, maybe it's worth 6.5 million. It's a huge, huge present you can give your spouse, your kids, and couple that with life insurance and other savings. It's extremely valuable. Last thing I want to get into is after-tax contributions. I'll probably do another webinar just on this. This is something that people don't understand. I don't know why. Maybe because it's relatively new, 5 years old. What it is basically says this. There's basically, remember I talked about employee deferrals and employer contributions. Employee deferrals are dollar for dollar, optional, pre-tax or Roth, and then profit sharing is a percentage. In the middle, think about after tax. After-tax contribution is dollar for dollar up to 56 or 62,000. Now, number one, your plan has to allow for it. Not many plans allow for it. Ours do. Not allowed do. If you work at IBM or any company with employees, you're probably not going to be able to do after-tax contributions. Why? Because they have to test it. And if you work at IBM or Apple or Google or Tesla, you're not going to have enough employees that are doing after-tax contributions. You're going to fail the top-heavy test, and you're not going to be able to do it. But if you're in a small company, especially a solo plan, and it's only you won't fail that test. And that's why it's huge. If in the IRA Financial, close to 40 employees, there's probably 1 or 2 people that would do after-tax contributions. So I can't do it in our plan because I would fail the test. So I'm stuck doing employee deferrals, and then we do a safe harbor match. That's the best I can do. If I was self-employed, I would do the after tax. I would go 56 or 62 dollar for dollar. And then the beauty is under Notice 2014-54, I can do an immediate contribution to Roth and then move it to a Roth IRA. I don't need a trigger event, and I don't have to do a pro rata conversion. Notice 2014-54 basically said you can just move that bucket of contribution into a Roth. You don't need to do a pro rata formula, which is what was required before 1454 came in, and why no one did after-tax contributions, because if you had other money in the plan, everything would be pro rata. It would be impossible and very complicated from an accounting standpoint. So how about this? You make $40,000, okay? You're self-employed software consultant. If you did, and let's say you're a sole proprietor, okay, under 50, employee deferral is 19,000 plus, let's say 20% of 40, giving you another 8, 27. You could do an after-tax contribution if your plan allowed for it. Let's say 37,000 because their Social Security and FICA needs to come out, dollar for dollar, and then convert to Roth. You just were able to put away $37,000 versus 19 plus 8 or 27. Now, to do after tax, you have plan has to allow for it, number one. Number two, you got to be a Roth person, right? Because you're not getting a deduction. It's after tax. So if you want deductions, after tax won't work for you. But someone like me who loves Roth and doesn't care about pre-tax contributions, after tax works great. You then convert it to Roth, and you got yourself a whole bundle of money in a Roth, and you're able to stock away a lot more in a Roth than you would if you just followed the employee deferral employer formula of 1925 plus 20 or 25%. So after tax are huge. Notice 2014-54 gave its power. It's got a lot of juice. Unfortunately, not a lot of people understand it. If you get a free plan from like Fidelity or Schwab, they're not going to have the option. That's why most people don't do it. But if you use an IRA Financial or another provider that specializes in these docs, you'll have that option. If you want to make sure your plan has that option, let us know. It's super valuable. Obviously, if you're going to max out, if you make $1 million, it doesn't matter, right? You're going to hit your 56 or 62. But if you make, let's say 80, right? Let's say you're an 80 sole proprietor under 50, 19,000 plus 20 of 80, that's 37,000. If you did after tax, you hit 56. Okay, so you're able to put away 19,000, but it has to be Roth. So if you really don't want that Roth, you want that 19,000 on the deferral to be tax deductible, then you got to stay with the employee deferral profit sharing formula. If you don't care about deductions, then think about after tax. Again, your plan must include the option, and you got to be a Roth person. Secure Act. I got a few minutes before I get to some questions. Secure Act recently passed 4/17/3. It was done in end of May. So it significant. There was a bunch of provisions. I'll just go through a bunch the more significant ones. MEPs, multiple employer plans. It basically said it's trying to encourage people to save for retirement. So MEP legislation basically is saying it's going to allow companies in different industries to group together and have one plan document for, let's say, 15, 20, 50 companies, 5,500, save costs with administration, be able to save costs maybe on fees because you can bundle your buying power. And it's going to get rid of the bad apple rule, which basically said if one company screwed up, it would have hindered the plan for everyone else. So we'll see. That should make 401ks more popular. RMDs was going to move from 70.5 to 72 since we're all living longer. It's going to remove the 70.5 pre-tax IRA contribution limit. Roth IRAs, you can contribute forever so long as you have earned income. Pre-tax IRA was 70.5, that's going to be gone. 401ks aren't there either. You can still, as long as you have earned income, you know, own more than 10% of the business, you can still make contributions. Now with a solo plan or any 401k, you have to set it up in the year the contribution is for. So generally 12/31/19 for 19. They're going to change that and move that to when the company files its return, including extensions like a SEP IRA, which is pretty cool. It's going to end the stretch IRA, which allows you to pass IRA benefits to non-spouses. It's going to limit it to 10 years. I expect most of this to pass in legislation. There's a House bill, ERISA, that came up before the Secure Act. I think it's going to, Secure Act now went to the House. They're going to look at it. We'll see what happens. Sorry, this was in the House. It's going to the Senate. And the Senate's passed ERISA. So now they'll look at Secure Act and ERISA, and there'll probably be some consensus. For example, ERISA, the stretch IRA, they looked at a 5-year and $400,000 threshold. And then there was some other legislation that ERISA had that Secure Act didn't. So we'll see what happens. But I expect some retirement legislation to occur in 19. There's some consensus. Couple of some fun fact or fiction game here. Let's talk about this. Sole 401k can be adopted by any business with no employee, including a sole prop, LLC, or corp. Fact, right? Any business can adopt it. Self-employed, no long as you have self-employment income, no full-time employees over 1,000 hours for non-owners. Self-employed individual under the age of 50. Can I split my deferral, pre-tax, or Roth? Yes. So 19,000, that could be in pre-tax, Roth, or after tax. You can split it up. It doesn't have to all be one or the other. It could be 15,000 pre-tax, 4,000 Roth, whatever you want. Fact, the corporation employer contribution to a 401k are due when the employer's tax return is due, and employee contributions by 12/31. Yeah. As I mentioned, and in fact, the Secure Act saying you can actually set up the plan. You don't have to set up the plan by 12/31. You can actually set it up when the company files its return, which is pretty cool. But yeah, employee deferrals 12/31, profit sharing, company files a return. Self-employed, as long as you elect 12/31, you can actually contribute that money when the return is filed. A couple more. I got a few more minutes. If I have 2 jobs, can I contribute the max to both plans? No. Remember, the 402 limits per person. Once you hit 19 or 25, you're done. Profit sharing is per plan, which is why you can go above the 415 limit. If you have multiple plans, you can go above the 56 or 62 if you're putting money in. So let's say you have a solo 401k, you max out, right, 56,000, but you also work at IBM. You can't do any more deferrals into it, but let's say they gave profit sharing, you'd be able to get above that 56 on the profit sharing from the IBM, since it's a per plan. There's no control group rules because you don't own more than 80% of IBM. If I have a full-time job and already contribute that 401k, but contributed less than the 19, I contribute the difference to solo. Yeah, we talked about this. It's per person, so you can keep going. Let me get to some questions if I can. I got a couple minutes. I got a whole lot of questions. Wow, I'm not gonna be able to get to everyone. Someone wrote here, I have a solo plan since 15 and it doesn't reach the 250 gross balance. We have to file tax each year. Okay, thanks for that question. I didn't talk about administration. I probably will do a webinar in the next few weeks about 5500s because the July 31 deadline is due. 5500 EZ. If you have more than 250K as of 12/31/18, you have to file the 5500 EZ by 12/31 by 7/31/19. You can get an extension till October. It's 250K, including all assets, cash, real estate, stocks, whatever you get. You have to value them as of 12/31. If it's close, file it. We'll help you file. We'll help you complete it. It's very easy. It's literally 2 pages. Take you 5 minutes. We have very detailed instructions on our website. You can call us. Don't worry. But this person asked, also have some REITs or realty shares, investments or real estate, and they sent me every year a K1 statement. Do I have to file tax for those K1s? No. So 401ks don't file tax returns. All it files is a 5500 EZ. So you just have to include that value on the EZ. If all you have is a K1 for 40,000 bucks from this investment, don't do anything. I know it's hard for you guys to understand, and I understand that too. It's strange that, hey, what do you mean? I got less than 250 in a 401k. I don't have to do anything. Yeah, you don't have to do anything. Just keep records of your value if you get audited. But if you're under the 250K, there's nothing you need to do, but you need to include all your assets. Another thing, if you have leverage, if you use the solo K, you bought real estate and there's non-recourse leverage, let's say you put 100K in, $200,000 loan, what's the value? Value is 300. The IRS wants you to put the 300. They want you to file a 5500 EZ. I had one client that once said, well, the value is really 100. That's my net value to my solo K. And that makes sense. But again, when someone asks you how much your house is worth, do you back out the mortgage you have from Bank of America? No, you give them the value. So the value is the value. Even if you took a loan, you can have the ability on the 5500 EZ to put the loan amount, but you got to give the total value. So that's something to be just aware of. I will do another webinar on 5500 EZs probably in 2 weeks. I think I should do that. It's a great idea. Thanks for the question. But that's just how it works. Someone said, I need my CPA tax prep guide to see you read this. How can I do that? We'll send you a link so you can send it to whoever you want. For S-Corp 401k sole plan owner with salary of 50K plus taxable insurance of 10K, can 25 employer contribute based on 60? It's based off your W-2. So taxable insurance, no, it's what you earn from salary. So if you have capital gains, dividends, royalties, anything else that doesn't count from that business. Roth IRA contributions limit in addition to or not included the max 56, 62. Great question. IRA contributions are not included, but the deduction may be. So you can always put $6,000 or $7,000, 50. If you're under 50, over 50 in an IRA, even if you max out a solo K, the amount you contribute could be limited. And I've written an article for Forbes on this, happy to send it. But as you start making, once you're eligible to do a 401k, even if you put in money or not, based off your amount you've earned, that can limit on how much you can deduct in an IRA. So you could make the contribution, but it may be after tax, or you can just do a backdoor Roth IRA, which after 2010 is allowed. So yes, you could still do 6 or 7. Roth IRA, depending on your income, and I can talk to you about that. But even if you make $1 million, you can still do a backdoor Roth IRA, which that means is make an after-tax contribution to an IRA, and then immediately convert to Roth. And that will allow you to do that Roth. The IRS is just worried about too many deductions. So if you have access to a 401k, even if you don't contribute, you may not be able to make an IRA deductible contribution. You still can make an IRA contribution. I will be sharing this link. So everyone who sent me that question, you're going to get an email, not from me, but it's going to come from the webinar link, where you'll link the slideshow, and you'll be able to see the video if you want to look at me, or at least hear it. My voice is probably easier to digest than my face, so that's up to you. If people have questions, let me know. I will do a 5500 webinar in the next 2 weeks for everyone. Rental income is not eligible. If you turn that rental income Schedule E to C, then it becomes eligible, but then it's subject to Social Security and FICA. I have rental properties under LLCs that can be income for the solo K contributions. Depends. Schedule E, no, because you don't pay Social Security and FICA. Schedule C, Charlie, yes. So it all depends. That's about it. I have a lot more questions. I'm not going to be able to get to everyone's questions. I'm sorry. But I promise I will, if you want to reach out to me directly, please do. I'll try to do a blog about these questions or do a quick video on them. But for everyone who attended, thank you. Everyone who's listening at a later date, thank you. I appreciate the involvement. This is really important. I'm trying. It's important for me to educate all of you and at least give you some of the knowledge I have, because these plans are power, okay? They're power in your hands. These literally will make you wealthy, okay? Not only are you going to be able to save a lot of money, 56 or 62,000, but you can invest in what you know and trust. And if you're just, again, start at a decently enough early age, are consistent, and trust this process, you will be wealthy. You will be rich. I guarantee it. I've seen it from my parents. I've seen it from clients just in 10 years. And I've seen it from my accounts. Okay, this is not a secret. Unfortunately, we're not educated enough about it, but the rich people are, smart people are. But again, this could be bipartisan, biracial, doesn't matter where you were born, color of your skin, what religion you are. All the retirement system can make us all wealthy. Okay, yes, it takes time. It can't be done overnight. It's not a 5-year or 10-year plan. It's a 30-year plan, but it's a one-generational sacrifice. You sacrifice for your family. When you are 70 or you pass, you are going to be rich. Okay, even if you're 65 and your family needs money and you're going to have $2 million in your Roth 401k, Roth IRA, you can help that family member out. Okay, you're going to have enormous wealth, and it's going to be in a very tax-efficient account. I wish I can bash people over the head and make them understand this, but this is the secret to being rich. Okay, it's not a quick rich thing. It's not something you're going to see on Twitter or Facebook. Oh, get rich quick, make this investment, you're rich. No, it takes time. It is a sacrifice, not just the money each year, but you got to be patient. You got to keep the money in the account. I'm not so much worried about the investments, believe it or not. I'm more worried about just put the money in, maximize what you put in. Whether you're buying a mutual fund A or ETF B or real estate or whatever you're doing, over 30, 40 years, you're going to get from 6 to 15% returns, okay? Your money is going to grow. You're going to be rich, okay? You just need to trust this process. You're the smart ones who found this out. Unfortunately, there's so many people. I have friends that are doctors, lawyers, accountants, software engineers, business people, real estate developers that are rich, okay, but they're saving in the wrong account, or they're not saving at all because they're blowing it on cars or vacations. Even if they've just put away $7,000 or $6,000 a year in an IRA, and they just did that for 30 years, at least they'll have $700,000, $800,000 in an IRA. Imagine what you can do if you put away 19 or 30 or 40 grand in a 401k, or almost $3 million in a defined benefit plan. I mean, that's real wealth, and this is wealth that you're going to transform your family's future. Okay, and it's all possible. You just need to you're there. I mean, so I don't even need to preach to you guys. You're there because you're in the 401k. You're doing this. You care enough to actually spend an hour of your day listening to this stuff. So you're there. If you just need to teach your family, teach your friends, teach your colleagues, talk to them about this stuff. I don't care who they set their plan up with. Go to Fidelity, Bank of America. It's not important. They don't have to use IRA Financial. Save. Because ultimately they will use us if they want to diversify to buy real estate or other assets. We will give that investment option. But even if you just want to buy stocks or mutual funds to start off, do it. Just save. Okay, that's if you take anything away from this hour, take away that. You guys are there. Keep saving. Keep doing what you're doing. Keep caring. Keep being passionate about what you're doing, and it will pay off. I guarantee it. I've seen it, again, with my parents, seen it with my account just in the last 20 years of working, and the math doesn't lie. So thanks again. I will do a webinar on the 5500 for all our 401k clients in the next 2 weeks, and then there'll be another webinar after that on 401k, on the next part of the 401k series. Thanks, IRA Financial, Adam Bergman. Really appreciate you guys taking the time to listen and watch. It's going to pay off, I promise. Thanks again.